Oh, the Genius Act specifically refers to what are called stable coins, and I'm sure most of your viewers know this, but just to not leave anybody behind, a stable coin is a digital token that trades on blockchain rails, but its function is to maintain parity with some other asset. So the most popular ones maintain parity with the US dollar, right? So like one stable coin with its, Tether or Coinbase has theirs, USDC, that they're supposed to have a market value of exactly $1. Now, in practice, they might not, it might deviate, but there's supposed to be mechanisms in place that if it falls to 98 cents, that will push it back towards $1 and so forth. So where that, just to give a little of the background, because at first, when you hear that idea, you might think like, I thought the whole point of like Bitcoin or whatever, especially if you go to the early days and read, that genre of the people who were excited about Bitcoin, it's because they didn't like government issued fiat currency. And they're like, oh yeah, the dollar and the euro and the yen, these things are, you can't stop them. They can just print more money and whatever. And so that's why we have rampant inflation. Whereas Bitcoin, nobody's in control of that. That's this autonomous thing. So let's get into that. And if we could just get more people into this non-inflationary. And so given that, the historical background of the origin of the excitement over this new thing called Bitcoin, it's funny that right now, like one of the leading things that's traded on blockchain is something that by its design is tied to the value of the US dollar. But the reason for that, like where that came from, is that originally, people who had their wallets and they had portfolios of all these different cryptocurrencies and Bitcoin and Ethereum and some of the more exotic ones, they were very volatile. And so, maybe, I made 82% year to date on my Bitcoin. I want to, take some profits. I want to park some of it in cash. And so before stable coins, you would have to like sell that off to get US dollars wired to your checking account and like sort of take it out of the blockchain world and put it back in the TradFi. Whereas if you have other tokens that live on blockchains that are designed to maintain parity with the US dollar, you can, just trade some of your Bitcoins or Ethereum or whatever for some stable coins. And then you sort of park your money, quote, in cash, right? So that's where these things came from. And so the problem is that these things in the beginning were largely unregulated and people weren't sure, like, well, what's backing them up? Like, yes, thus far we can look at the history and see that these things tend to trade close to par with the dollar. But what if there was a financial crisis and everyone's rushing to redeem them? What would happen? And so what people realized is these stablecoin issuers were like banks in the sense that people would wire them real dollars in the sense of like checking account balances, then be issued these stable coins that at least, ostensibly we're supposed to trade at par, and they'd be going and doing things with them, buying stuff from merchants or whoever who accepted stable coins as payment. So that, like I said, the stablecoin issuer was like a bank where, you think of a conventional bank, you go in with green pieces of paper, you make your deposit in your checking account, and you're walking around town saying, oh, Citibank owes me $1,000. And then merchants will accept liabilities from Citibank as if it's the same thing as if you had a $100 bill. But technically they're not the same thing, right? So it's likewise here, you might think I have $1 million worth of Tether or USDC, but what if there's a panic in the markets and then the exchange rate drops? Maybe you don't, right? So the Genius Act was supposed to sort of clean all that up and provide assurance to Americans, because that's the jurisdiction, that if you get what's called a payment stable coin from an approved issuer, that you can be sure they have assets backing it up. And so specifically, it requires 100% reserve backing of circulating stable coins. And when they say, well, what kind of assets can count as reserves, it's pretty stringent. So it's like literal checking account balances or currency coins, but also treasuries, but they have to be 93 days of maturity or less left on them. Right. So the idea is to have very liquid USD denominated assets that are like backing up 100% all of the stable coins. And again, the function of that is to sort of foster trust in this system.